Welcome back to live coverage here on Yahoo Finance. I'm Shauna Smith. We have stocks getting a boost here to end the week with the major indexes on pace for their second straight week of gains. Now, the markets are getting a boost after a report that Gilead has a drug showing some effectiveness in treating coronavirus. So investors right now are hopeful that we could soon see a treatment. Leadership-wise, we're seeing the Dow up just around 400 points. The big by far today in the Dow is Boeing. That stock up well over 12%. Of course, this is on the heels of the news coming out of the company yesterday that they do plan to reopen manufacturing plants in the Seattle area. So we're going to talk a little bit more about that later in the show. Sector-wise, we are seeing gains across the board. Energy is the big leader so far with the XLE up over 8% this afternoon. We're also seeing some significant gains in financials. So a lot of those financial names moving to the upside. So for more on this, I want to bring in Tom Hayes, chairman of Great Hill Capital. And Tom, let me just get your thoughts on what we're seeing in the market today. So sentiment is improving, obviously, on the heels of the progress that we got overnight on treatment. What do you think of the rally that we're seeing today and really the resilience that we're seeing in the market?
Yeah, well, the market, as you know, Shauna, is a discounting mechanism. So just as we crashed 35% in February, March, anticipating the bad economic news we're seeing today, with the advent of the potential hopefulness of the Gilead drug remdesivir and reopening the economy, you're seeing the laggard cyclical sectors anticipating a recovery of demand coming back into play. As a matter of fact, this week, Bank of America put out its global fund manager survey, and in that, the expectations were 93% of people, of fund managers expected a recession, which was the highest since 2009, and cash levels were at their highest since March of 2009, which marked the bottom on the S&P of 666. So the pessimism is really high. And the other thing that I look at, Shauna, is when the boat is excessively crowded. It's interesting to see with the economy reopening, the four most underweight sectors are all the ones that are performing today. So it was cyclicals, energy, industrials, and banks. As a matter of fact, last month, banks were at their lowest owned among these managers, 200 managers that control $500 billion of assets. The last time that they were this under-owned was July of 2016. And over the next 18 months, banks nearly doubled. So it's not to say that that's necessarily going to happen, but as we can see a light at the end of the tunnel with possibly with remdesivir, and possibly slowly and cautiously reopening the economy, these type of stocks are going to start to pick up demand.
Hey, Tom, you mentioned that Bank of America, the survey that was out, the flow show note. I want to ask you about that because the one thing that caught my attention in that note was how they were talking about the S&P is now more concentrated than ever in the five largest stocks. So that, of course, is Microsoft, Apple, Amazon, Alphabet, and Facebook. When we take a look at that, does that concern you at all at this point?
Yeah, the breadth will widen out, I think, as we see demand pick back up in the cyclicals. I think a good model, if you look at, we're about 2 months behind China. If you look at their economic recovery, their new cases peaked on February 5th. The administration believes our new cases peaked sometime this week. And you're already seeing, according to Bloomberg, employment is back up 90 to 95% of pre-pandemic levels in China. You're seeing the TomTom GPS data. Rush hour traffic is at pre-pandemic levels in the big cities. You're seeing seats in the air data from third-party providers. The trough was 4 million seats in the air in February. It jumped to 8 million seats, obviously down from 14.7 million peak. But you're definitely seeing it with energy demand starting to come back in China as well, with their coal plants burning at pre-pandemic levels last month in the month of March, as well as all the American companies now starting to see a recovery. Like Starbucks comps went from negative 90% in February to negative 42% at the end of March. Disney slowly reopening their park in Shanghai. Yum China reopening their stores. And Apple, by the way, handset sales month on month, February to March, were up 241%, and they're only down just over 20% year on year. So I think now that demand is coming back in, Shauna, I think that people are saying that maybe we can start to look at some of these cyclicals and not just focus on that narrow part of the market.
But Tom, do you think that investors could be getting a little bit ahead of themselves, though, because we don't know how long it will take in order for the U.S. economy to reopen? We know that the Trump administration laid out 3 phases of that last night, but the timing of this is still all uncertain. And when we pair that with the fact that we just keep getting weak economic data, I mean, just this week, we had the jobless claims number, retail sales, and housing data that was all significantly lower and in many cases underperforming what we were expecting. So why do you think investors, though, have been able to shrug that off? Is it solely just based on what we're seeing, like you were saying before, out of China?
Well, I think that's part of it, Shauna, but I also think that people are underestimating. So even if you look at the worst case scenario for GDP, so some houses are calling for 20% GDP contraction, 30% GDP contraction, even more. But if you do the math of the average over a quarter and a half, you're looking at a 1 to 3, basically $1 to $2.5 trillion of GDP contraction. Well, that's the size of the pothole. But let me tell you the size of the asphalt. What the government has authorized to fill that pothole in terms of asphalt is now exceeding $8 trillion. You had the 2.3 of direct stimulus and aid. You have the expansion of the loan facility through the Fed and Treasury working together of $4 trillion. You have the Fed balance sheet has expanded by another $2 trillion. And you've got a potential infrastructure deal in the works and another $250 billion for small businesses. So when you look at it in that regard, when there's no demand, it doesn't matter how much money you throw at it. But once that demand comes back, as we slowly but surely reopen the economy and carefully with testing, tracing, the right treatments, and hopefully, if you want a V-shaped recovery, V equals vaccine. You definitely need that towards the fall. That amount of money is going to lead to real growth. And again, we'll see it probably the back half to the first half of next year. And the market is starting to sniff that out. Maybe it's a little bit ahead of itself, like you said, but there's certainly good to come so long as we do this reopening correctly and we get the health stuff in place that we need.
All right, Tom Hayes, thanks so much for joining us this afternoon.
Thanks for having me, Shauna.